Hi there, and welcome to the webinar, How to Effectively Use Asset Allocation to Improve Your Investment Returns. My name is Adrian Nathaniel, and I'm delighted to present this to you today. So, in today's webinar, we're going to be going through some different aspects around asset allocation, and what you will learn is actually what an asset is, what asset allocation is, risk versus return, and understanding how to strategically allocate your capital, and finding out also how asset allocation should change based on your age. And also, we'll be exploring what a mega trend is and how that can impact your investment returns. And finally, we'll be exploring speculative investing and how that can be used as an asset class as well. So let's dive straight in. And so, what is an asset and an asset class? Essentially, it's just a type of investment vehicle. And there are 5 to 6 main different types of asset classes. As you can see here on the screen: cash, fixed interest, property, gold, infrastructure, and shares. Now, ideally, to get the best outcomes for you, it's best to diversify across these different asset classes. And ideally, the correlation between each of these asset classes should be really low, because let's just say that there is some financial volatility in the share market. You don't want it to also be experiencing that in your other asset classes as well. So, and I'll be going through this a little bit later as well. Now, I'll just describe a little bit more about each asset class. So cash, that's pretty self-explanatory. It's just like cash in your bank account. It gets the lowest returns, and depending on inflation, you can actually be going backwards. Fixed interest, that refers to a fixed return over a period of time, and it includes structures like term deposits, government bonds, green bonds, climate bonds, and social bonds. So essentially, it is an amount of capital that is loaned out. It's like a loan, and different companies or countries pay back that loan with a fixed interest rate over a period of time. Property, this is perhaps one of the most favourite asset classes for Aussies. In this asset class, the income can be fairly consistent based on rent. However, the value of the property can fluctuate. And depending on what type of property it is, whether it's commercial, industrial, residential, it has different levels of risk regarding the rental income as well. Gold. Gold is an interesting asset class, and it historically has been considered a safe haven. And, uh, and this is because it has an inverse relationship to shares. So whenever the share market starts to fall, people historically have moved into gold, and so gold tends to go up when the share markets are falling. But I'll go into this a little bit later as well. Infrastructure, this asset class depends mainly upon income through utility companies, toll roads, airports, etc. And of course, shares. This asset class is typically publicly listed companies, and you owning a share of those companies. So each of these asset classes has a level of return that correlates with risk. So, like for instance, with cash, it has a low return, but it is low risk. Okay, whereas on the other end of the spectrum, you've got shares, you get higher returns, but the risk is higher as well. And the risk that we're referring to here is risk of volatility. That is up and down movements of the share market on a daily basis. Now, the thing to consider here is that volatility is only ever really reflects fears based around short term. So it's short term fears around what may or may not happen to companies or to the economy. And we certainly experienced that at the beginning of the coronavirus pandemic, when there was a lot of unknowns. No one knew what was going to happen, how the government leaders were going to respond, how the company or economies were going to be impacted. And so consequently, there was a lot of fear, and the response was to sell off all the shares, and there was a huge drop. And but then there was a gain come back again, as soon as people felt confident that there was going to be some sort of response from leadership, then people felt more safe, more confident to come back into the share market again. And we've seen recovery as well. So the best way of looking at the share market is at a minimum of a 12-month basis. That way you can see over time the markets generally fall back to the true value of a particular company. Now, as I indicated before, different asset classes have different relationships with the share market in particular, and you need that. You need to have a low correlation with the share market, because, like I said before, if the share market is experiencing great volatility, you don't want your other asset classes being impacted by that as well. So the key to managing risk is about diversification. And ultimately, that's the first thing that you need to consider when investing, is how to manage risk. And so to diversify across different asset classes is fundamentally one of the best ways of managing risk. So let's explore the property asset class a little bit more. Okay, so as far as like investing into you can invest via listed property. Listed property is typically property trusts that are listed on the stock exchange. Okay, as opposed to owning a direct property asset like an investment rental property, or a direct commercial property in your own with your own capital. So that is just one asset, one property, whereas a listed property tends to be diversified across a range of different office spaces. Well, okay, so with listed property, it's typically commercial or industrial spaces. And so what listed property companies, trusts do is that they diversify across a range of different either office spaces or retail shopping centers, or either industrial spaces as well. So like I said before, there is risk there, that and definitely in times like around with the coronavirus, where retail has been hit significantly. And what we've seen here is that some of the rental income from the commercial spaces has dropped. Okay, so it does become a high risk asset class in that instance. Okay, so this needs to be considered. Now, the other thing to consider here around diversification and around having a low correlation with the share market is, one of the aspects to get a low correlation is to have an unlisted asset class. What I mean by unlisted, it's like it's direct, like owning an investment property yourself. So it's not on the stock market at all, or having a direct commercial property yourself. So that is one way to reduce the impact somewhat of the volatility of the share market is to have an unlisted asset. So moving on to the next asset class, gold. So gold is, like I said before, it has an inverse relationship to equities or the share market. And traditionally it's been used as a safe haven. So like I said before, whenever there is a lot of volatility in the share market, the investors typically move their cash to gold or have a greater percentage, hold a greater percentage of their capital in gold, and because they view it as a safe haven. And so that this gives it an inverse relationship. And as you can see there by this little diagram I've got here, the black represents the gold, and the white represents the share market. You can see as the share market may go up, gold will go down, and you can see this historically too. So be aware of any reports or articles that you might receive from different media companies saying, buy gold, buy gold. Gold, usually the best way to approach gold is it should only represent 5, maybe max 10% of your portfolio. And this is because the share market spends at least 8 out of every 10 years going up. And so during those 8 years where the share markets are going up, gold is not doing much at all. So if you've got all your money in gold, you're not doing much at all with your capital. Okay, so it should represent 5 to 10% of your portfolio. So when that volatility hits, then the price of the gold goes up, and then you get a more balanced outcome for your portfolio. Okay, that's the way to manage this asset class. Infrastructure. So infrastructure is typically assets around toll roads, airports, utility companies, anything that allows us to connect with each other as well. So typically it is based mainly on income, and it typically has a low correlation to equities or the share market. But you have to be careful here, not all of them do. And so the key here, once again, is to see if your infrastructure asset class has try and get a higher exposure to unlisted assets within the infrastructure asset class. That will reduce its volatility and its correlation to the share market. So now, like I said before, ideally the asset mix is really important. How you put together the asset allocation. Like I said, gold 5%, infrastructure should only represent a maximum of 10%, property around 10%, and then you can then allocate a certain amount to shares and then fixed interest. Now this actually, it's really important to also diversify within each asset class as well. So what I mean by that is that with asset classes that are listed on stock exchanges, they will have a certain exposure to different countries and different sectors. Okay, what I mean by sector is like different industries. So, for instance, with the equities or share, the share market, you'll have different funds that will have like either be global or international or Aussie, Australian companies. So then ideally the best way to do is to then have if you're going into the share market, to have a bit of the Aussie bit of the international, but then within each one of these, you want to actually further diversify and just check to see how much exposure is in each country. Predominantly, you'll see that a lot of the international funds have a high exposure to the US. Up to 60 to 70% of an international fund is typically in US companies. So depending, and this raises the other risk of political risk, and depending on the leadership of that country at the time, you may want to reduce that risk as well by finding a fund that has a more balanced exposure around the world. And then, of course, like I said before, the sector, that's what industry are you in? Are you going to be more in health, tech, whatever? And I'll go into that with the mega trends. I'll explain the importance of the sector in a moment. And then also index versus active. So index is when it just follows the index and what it, like the ASX 200 or the Dow Jones or the MSCI. So an active fund, this is where the fund managers are actively and proactively managing which companies are in their portfolio. They're not just following the index of the top 20 or 200 companies. So ideally, an active manager would reduce your volatility as well, and you may even find some outperformance. So now, going on to risk profiles. So this is, and this should change as you get older as well. Typically, it's investing is all about time in the market. Your time that you have to be in the market. Okay, it's really hard to time the market and to try and get in at the right time and out at the right time. Really, no one has a crystal ball to predict exactly the right time. So it's about being time in the market. And if you're aged in your 20s or 30s, and particularly like with your super, for instance, you can't typically access that until at least age 60. And so if you're in your 30s, you've got 30 years before you can access that money anyway. So you've got time to ride through any volatility or any periods, downturns, any bear markets. You've got time to recover. And just to give you an example of that, in the GFC, those who remained invested, they were able to reach their pre-GFC highs within 5 years. Okay, so and then after that, it just was just cream on the top of that. So if you're in the younger you are, the higher risk you could afford to be. Okay, what I've got here on the screen here is just some different types of risk profiles that you'll find in a typical super fund. Conservative, just to give you an example, is usually around 65% defensive. Now, growth. Okay, so defensive assets are typically considered cash and the fixed interest. Growth assets are the equities, the share market, and property fits in with that too, and the infrastructure can. So the property, infrastructure, gold, those sort of asset classes are considered growth, but they're also on some of them can be a little bit defensive. They can behave defensively depending on their correlation with the share market. So moderately conservative, this is where you've got around 55% of your capital in the share market or property and infrastructure, and 45% in fixed interest and cash. And balanced is typically the term given to those portfolios that have at least 70 to 75% of the portfolio in growth and like shares, property, infrastructure, and 25% in defensive. Now, let's get on to a megatrend and how that can impact your investment returns. So typically, megatrends are those macro events that can influence political, environmental policies, health, longevity. They're big events that are occurring over a long period of time. The first great megatrend can be considered the Industrial Revolution. And during this time, there were particular products and services that sort of supported that megatrend, and they were around oil and steel. And you may remember, or you may be familiar with some of the names of that time, the Carnegies and the Rockefellers. Their families were involved, had owned large amounts of shares of companies that were in oil and steel. And they consequently became billionaires. So the megatrends have definitely shifted. Some of the megatrends now are around aging populations, digital technologies, and climate change and sustainability. So if you think of any of the products and services that are supporting these megatrends, then that's where you want to be. This is where the evolution is taking us. So some other asset classes include speculative. And speculative investing, it's typically around startups. So companies that are really young, they're early in their forming or formation development cycle, yet they show a lot of promise. And so what we've seen here over the last several years is a lot of tech companies move into this space and just grow rapidly. And so this is the can be one of the outcomes of speculative investing, is that there could be massive amount of growth, like 100, 200, 300, 500% growth. However, because it's a startup, okay, there's a high chance that it will fail as well. You may have heard of the phrase, the comments around 80% of new businesses fail. So this is the thing. If you're going to invest in startups, it should only ever be money that you can afford to lose. It is so typically it should only represent around about 5% of your portfolio as well. However, there is opportunity there for massive growth, and this is where this is over the next 5 to 10 years, we're going to see businesses and companies and industries that we never even heard of before start to rise up. And this is where following the megatrends can really assist with that. So some of the foundational principles that I follow is around managing risk first. Okay, first and foremost, you've got to manage risk. And then I like to look at sustainability. You know, like if a company is targeting sustainability, they would also, in addition to profit, they will be looking at their environmental impact and their impact on people and their staff. And what I've been finding is that these companies typically outperform other companies while also receiving less environmental fines and less corporate violations. So there is an inherent risk management in companies that are targeting sustainability as well. And then, of course, the funds need to be affordable. Each fund has a different management fee, the fund managers, and also you're going to need to consider how they're going to perform as well. So, some words to ponder before we finish. If you look at nature, diversity is a natural key to abundance. And if you are interested in anything that I've been saying today, I encourage you to get in touch. Here's my phone number, my email address, and my website. And yeah, I wish you all the best with your investments. Take care.